Commercial property group Vukile Property Fund, which owns malls in South Africa and Spain, says its full-year distribution per share of funds from operations rose 6%. Vukile is among those few property companies in South Africa that focuses on building shopping malls in primarily rural and lower-income areas of the country. The group increased its total dividend for the financial year and expects it to grow further in its new financial year amid lower-than-expected pressure on consumers over the past 18 months. I spoke to CEO Lawrence Rapp for more.
It's been a fantastic year for us, characterized by very, very strong trading results in both Africa and Spain. Our business, as you know, is around 60% of the assets are in Spain, 40% in South Africa. From an earnings point of view, roughly 55% though from South Africa and the balance from Spain. So a very strong rand hedge element to what we have. Overall, really, the strongest results, in fact, that we've posted in South Africa since listing nearly 2 decades ago. We've seen vacancies drop to 2%, very strong tenant demand, pushing reversions from negative 2.5% to up to 2.4%. So that's been really positive, and I think characterized by our tenants doing well, with growth in trading densities exceeding 6%, and our property NOI increasing by over 5%. Spain had a market-leading performance. Their net operating income grew by over 9%. Their vacancies are a negligible 1.3%. And I think characterized by the strong demand in that we're seeing not only vacancies coming down, but also seeing rentals going up. So there we had positive reversions of around 4.2%. So all in all, exceptionally strong trading in both markets. And I think that was the hallmark and the foundation on which these results have been built.
Let's look at your SA portfolio. Given the macroeconomic environment, what kind of data are you picking up in terms of your shopper behavior at your malls? So definitely seeing some increasing level of strain coming on the consumer in probably the last, I'd say, 4 or 5 months. And that could be a function of one of two things, or both. It could be sort of the higher interest rates coming through, but it could also be the impact of more hours being affected by load shedding than in the first half of the year. So, for example, in the second half of the year, about 8.8% of our trading hours were lost due to load shedding. In the first half of the year, that was only about 4.8%. So definitely that is there. So what you're seeing is still sales and footfall growing at a positive rate, but at a slightly lower rate than what we saw in the first half. So we're seeing in some of our market segments a slightly lower spend per head, but on the whole, what we've seen is that shopping patterns are coming back to where they were pre-COVID. So we're seeing weekend trade coming the dominant trading period, where during COVID that was more midweek. And we're also seeing, first week of the month, last week of the prior month being the stronger trading periods. So what we need to do is really sort of find promotional activity to drive footfall in those periods. And I think that has been happening. But overall, when I look at our portfolio, it's performed exceptionally well in the past year. We track 14 different categories of retailers in our portfolio. 12 out of the 14 experienced positive growth over the last year. The only 2 were in electronics and homewares, which was slightly down. And that, again, is probably due to, A, the fact that they came off quite a high base in COVID, but then secondly, in a more constrained consumer environment, your durable spend does tend to be affected first. So what we're seeing is sort of patterns that we would expect, but overall being positively and surprisingly happy with the performance of the consumer and how they've held up in the last 12 months. On the impact of load shedding, I think that has been a major theme, at least when you look at some of the JSE-listed companies that have published their numbers over the past few weeks or so. Are you seeing a major impact of load shedding on footfall or trade?
So as I mentioned, we did see a slight drop in footfall, still positive, still ahead of all prior benchmarks. So nothing that has been dramatic, although slightly down from the first half of the year. Obviously, it's a key trend, a key issue we need to be dealing with. We've recently launched a 350 million rand spend of introducing solar and battery solutions into our top malls.
which will guarantee the lights on between 9 and 4 during the day. Now, that is done on a basis that is cheaper for the retailers than providing their own generators. It's better for the consumer because when they come to the mall, they're guaranteed of all the shops that they want to visit, having lights and being able to trade. For us, it's yield accretive. And obviously, from an environmental point of view, you're relying on sustainable green energy, not burning fossil fuels. So that is something that we are rolling out during the course of the year. It's a way that we think we will manage load shedding, as well as lowering the cost of electricity going forward for our tenants and our customers.
Do you see any other risks across the portfolio when you look at the South Africa operations?
Well, I think a very important part when looking at Vukile is to understand that more than half our business is located in Spain and therefore is exposed to very different risks. So many of the South Africa specific risks have a much lower impact in our business than, for example, a competitor that might be 100% exposed to South Africa. So I think that provides a tremendous amount of diversification for investors by realizing that we really have contracted out of a lot of the SA Inc. risk, so to speak. So that is a general benefit. Obviously, we watch the political situation quite carefully, how that unfolds, impact on consumer spending. Those are probably the main issues to go along with load shedding. Obviously, water security is another issue. We've sort of been very proactive in that regard. So over the last number of years, we've already been drilling boreholes, providing backup water. So today, around 60% of our portfolio already has backup water. In the more challenged rural areas, 100% of our malls have got backup water supply. So we are worrying about that. We are worrying about local service delivery from local municipalities. But really the way we deal with that is by becoming as self-sufficient as possible through water, through electricity and the likes.
What will be the areas of focus for the next 6 months?
Very much a tight focus on operational excellence. I think that is really what Vukile is all about. It's about bottom-up property management. I think you can see that in these results, how that focus has, paid dividends. It's making sure that we are absolutely laser focused on the needs of our tenants and our customers, making sure we can meet and exceed those needs. So even if the economy is not growing, we need to make sure we're getting a bigger market share and people are choosing to come to our malls and not competing malls. Our balance sheet is strong. We've already got around almost 90% of our interest rate risk hedged. Obviously, that is a major concern in this environment of rising interest rates. Fortunately, we don't have any major debt expiries for the next 2 years. So that also, I think, provides us with a lot of insulation overall. Ideally, we would love to look at opportunities. We think this is a very good buying opportunity. We are worried about the availability of equity capital to pursue those opportunities. But really, our main focus going forward is a very tight operational focus, understanding the consumer, making sure we are retaining tenants, filling vacant space, and really making sure our malls are offering great spaces for our shoppers to be in.